Today, a report from the University of Michigan revealed that consumer sentiment is at its lowest level in more than 3 years. And that is near its lowest level ever. The government shutdown worries have surged in early November. And let's take a look at that fear and greed index for just a little bit of visual to kind of see this as well. So obviously we have the government shutdown that's overhanging us. So this is the longest government shutdown ever. Today, we thought potentially right before the market started to close that there may be an opportunity to close that shutdown and move forward, but unfortunately we did not get the votes, and so we are still here Friday evening, November 7th, still hopefully crossing our fingers and waiting patiently for the Republicans and Democrats to come together, come to an agreement, and end this shutdown. If you're not aware as well, a transportation secretary, I think it's Sean Duffy. If I butchered his name or if I got his name wrong, my apologies. But there was announced earlier today, that there's a 4% rollback in flights. So from my understanding, they're going to delay some flights, and then they're going to cancel some flights outright as well. I remember there was said maybe 40 major airports may be affected as well as others. And then if the government shutdowns continues to last longer, they're going to increase that amount and continue to delay and continue to cancel flights outright. So if you guys are planning to travel anytime soon, you probably maybe want to reschedule if you can, until these things are settled. But we have the government shutdown. We have the Supreme Court. Sounds like making their decision of what is to come with Trump's tariffs. Are they going to have to refund the money, or are the tariffs going to be deemed constitutional, or whatever the language is? But some folks are saying if the Supreme Court rules against Trump administration, the stocks might rally. And then I don't really know what to think right there. I'm just kind of wait and see exactly what happens and how things are going to move forward. But there's a lot that's going on that is weighing on consumers, weighing on market participants' sentiment. And you can see with this extreme fear and the fear and greed index. I always like to remind myself, and this is quoting from Warren Buffett: be greedy when others are fearful. So this might be a time for us to take advantage and buy assets at a discounted price. And we'll talk about that today. It definitely happened today, but don't go too crazy. We are in uncertain times. The last thing you want to do is go all in here right now. But before we dive into some individual stocks, I'd like to go over just this past week what's been going on, and we're going to check the scoreboards. Now, if it's your first time watching us, the scoreboards are the three major indexes, the S&P 500, the NASDAQ, and the Dow. Remember, the NASDAQ is going to be tech heavy, and so you can see right here on the left-hand side, those three major indexes, the S&P 500 and the Dow, were positive today. But because we have a lot of pressure in the AI trade and tech, it was down today. The NASDAQ was down, but not far off, not far down today. But I did want to kind of look over the past week because it's been a very volatile week. Now, September and October historically are weaker months, okay? And so we were expecting some type of pullback in September, and that did not happen. We actually had a nice little rally in September. So then everyone thought, all right, maybe this is delayed until October. Well, October came and passed. October was a positive month for the market overall. So now we are here in November. Historically, November is typically the start of a nice Santa Claus rally, they like to say. So November going into to December is strong as well, and then January to start the year is typically a strong month as well. So we did not get that correction or that dip that a lot of people were expecting. Every time we did get a dip, it seemed like folks rushed in and bought the dip. A lot of retail traders have been doing that. If you're not familiar with what a retail trader is, it's just your everyday investor, opposed to the institutions and the big boys. Those are, I just like to call those folks the sharks, the big fish in the ocean, whereas retail traders are more like the guppies, little small fish, and we're just swimming around living our lives while the big fish really make all the decisions, really make everything move. But if we all get together and we're concentrated and we all, move together, you can see what's been happening this year. Every time we get a little bit of a dip, people rush in and buy. And we saw that today as well. But for the S&P 500 is down 1.6% for the past week. The NASDAQ down 3%. Remember, tech stocks are under pressure, so it's going to be a little bit more elevated than your S&P 500, which is a little bit more balanced of the best 500 companies, but it's more balanced opposed to the NASDAQ. And then the Dow, the Dow was down just over 1% for the past 5 days as well. So we're off of our highs, but we're still in a good space. We're not seeing a major correction, and we did see a dip today down to, let's get into it in just a moment. We'll talk about some key levels we're looking at, some of the investments we're in. Before we get into individual stocks, though, I did want to highlight Bitcoin was at 100,000 this week, a little bit less than that. Remember, we were saying when it was 120, 115, if it got down to 108,000, that was opportunity for us to start adding on again. Well, we're below that 108,000. We actually dipped into 100,000s. And so we've personally been adding into Bitcoin. Haven't really touched Ethereum because we had a decent amount in there. So now we're just getting a little bit more exposure into Bitcoin. Just wanted to point that out for you guys. If anybody's interested in getting into Bitcoin or wanted to know if this was a good price, we are getting in, and I've heard a lot of folks are getting it at this level as well. All right, so let's talk about some individual stocks. The companies we talk about in this portion of our portfolio are our highest conviction plays. We have the most funds allocated towards these 7 stocks than any other companies in our portfolio. And that is NVIDIA, Meta, Apple, Amazon, Vertiv Holdings, Uber, and Robinhood. Okay, so let's go over how they performed today, so we can talk about some of that price movement today, and then we'll go over how they've been moving for the past 5 days, the past week. So NVIDIA closed today, pretty much broke even today, but you can see it was down almost 5% today. And previously, we jumped in, we were buying some long shares, and we were buying NVIDIA options. And the level that we were buying at was $180. We were saying that's the level we're looking at. Well, NVIDIA fell today to 178.92. And once it fell, hit that 180, dropped below it, then it just shot right back up. And remember, it was down almost 5%, moved and pretty much broke even today. So we see that 180 mark is a key level for us. So just remember, NVIDIA 180, remember that number, NVIDIA 180. Now, piggybacking on that, QQQ. Now, QQQ is an ETF that follows one of the scoreboards we talked about, the NASDAQ. Okay? The NASDAQ composite, the ETF for the NASDAQ is the QQQ. It's a very popular trading ETF, QQQ. Now, we got into a play with QQQ, and that key level was 600 when we were investing earlier successfully. And you can see here, the QQQ was down today 2%, which is a pretty substantial move for the Qs. Down 2%. It got down to, remember I said the level was 600. It got down to 198.67. It bounced off of that. It did finish today lower. It didn't not creep back into positive territory. But again, it was good to see it hit that $600 level, tested it, and then shot back up. So that is a key level for us to remember in the Qs and NVIDIA. If you're not comfortable, you want to get its exposure to the AI trade into technology, and you don't want to invest in individual stocks. The QQQ is why I suggest. So remember 600 level for the QQQ, and then NVIDIA, remember that $180 share price. Okay. Meta. Now Meta's been getting beat up. It did finish positive today. Let's look at, we'll look at Meta's for the past 5 days. Now Meta is down 4% the past 5 days and down 13% the past month. And that 13% drop is really after its earnings report. They actually had a pretty decent earnings, besides they had a one-time charge. I think it had something to do with the big beautiful bill. They had a one-time charge, and they are upping their expenses, and so investors did not like to see that. It's kind of like deja vu all over again when Meta was investing heavily into the metaverse and they were losing money, and there was really no light at the end of the tunnel that investors could see. I guess Zuckerberg didn't really explain his vision, explain exactly what was going on, and so investors just sold, and it really drove down Meta. And I believe we could possibly be at the start of that. Investors are not liking the spending that they're doing and how they're using debt to fund these AI initiatives that they have in the future. But at the same time, if Meta just stops spending, that means that they're essentially just giving up in this race, this artificial AI race. And so if they want to compete, they have to continue to spend. And so if, Microsoft is getting hit as well, Google's doing well, but they've also shown, their metrics, their margins and everything, or their revenue and everything is not impacted the way that Meta and your Microsofts are, and others, or like your Apple, who isn't investing substantial amounts of money like these hyperscalers like Meta and Amazon and even NVIDIA. And so they're more so as like a defensive play, and the narrative was that Apple was behind in AI because there was really no plan. Now, all of a sudden, we're flipping that switch and we're saying, well, Meta's investing, but they're investing and they're raising their expenses, but we're not really seeing a return. Well, we are seeing a return. It was just this quarter we had that one-time charge that impacted the company. So, little secret, Meta is going to be one of our plays for 2026. That's going to be one of our plays, our favorites for 2026. So just keep that in the back of your mind. This is not something we're going to give up on. If anything, a lot of the investors that I listen to and I respect what they have to say, we're saying they're actually adding on to Meta here rather than selling. And I think that's probably the right approach, but just be cautious and mindful that this might not be something that's going to be fixed within a quarter. It may take 3 quarters or so before we see any type of difference in what Meta's reporting in their numbers. But they're rolling out the new line of Ray-Bans or Meta AI glasses or lens. And so those seems to be popular. I've seen like every time I walk down the street, I was just in Vegas for the past couple of weeks. I've seen a lot of people wearing them. Facebook, their family of apps are doing perfectly fine. If you don't have any exposure to Meta, this is a great opportunity for you. All right, moving on. We already talked about Apple a little bit. It was down today It was up for a little bit. Uh, Down past 5 days, down 0.7%, just about 1%. I did want to go back over NVIDIA. We didn't talk about it past 5 days, but NVIDIA is down 7% past 5 days. Amazon is a company that we really were excited about because we got in right around the time where Oracle was running hot because they had that deal with OpenAI, and then Oracle stock took off. Uh, Amazon is the number one player in cloud, and they shouldn't be forgotten about. And they are doing extremely well with the cloud. And their most recent report showed why you don't give up on a leader in a space. And Amazon is doing just fine in their cloud business. They had the growth that analysts were looking for, and the stock took off. Finished up today about 0.5% and is up basically flat for the past 5 days. For the past month, we're up 10%. So we're excited, happy about Amazon. Vertiv Holdings, they are a partner with NVIDIA. They basically service the data centers and keep all the chips running efficiently and cooling them down so they don't overheat. So this is a major player in the AI infrastructure. We love this company. It was down just about 2% for the day, down 7% for the past 5 days, but up 13% for the past month. Uber. I've been pounding my chest. Uber was one of my picks for 2025, and that did pan out for us. Year to date, it's up 50%, so congratulations to us. Today, essentially flat, past 5 days, down 5%. This is another company that reported strong earnings, not like Meta where it had the one-time charge. They just had strong earnings. The business is growing. They're investing in new initiatives to spur more growth. If you think that, like, I understand Tesla and Elon Musk and all of that old deal right now with the vote, and it looks like Elon's going to be staying on to push Tesla forward. But if you think that Uber was just going to go out of business or was going to be non-existent because Tesla was going to roll out their robo-taxi or whatever the case may be, like, Elon's been talking about this for how many years? When he eventually rolls it out, they're going to have other people. Waymo's already out there. I rode a Zoox out in Las Vegas, autonomous vehicles. But Tesla is not going to be the only winner if and when they get these autonomous vehicles up and running, and they have their own app. More than likely, you're going to be able. Teslas are already on Uber right now. More than likely, Elon's going to use their platform and partner with Uber, and things will be peachy for both businesses. So I did not once believe that because Tesla and Elon were doing well and were supposed to roll out these robo taxis that Uber was not a business that you wanted to put your money into. And so I'm glad I was a contrarian in this investment. Uber is still one of my largest holdings. It's in this core 7. Their earnings, they tend to just sell off after their earnings if they don't just blow things out of the water. So if you don't have any Uber shares, right, that $90 mark where it hit today and it bounced off of that, that is a great place to buy. I just didn't want to buy because it was Friday. Who knows what's going to happen this weekend? Trump can say anything crazy and just send the market down after we worked our way back today, and markets closed at the highs of the day. So love Uber long term. If you don't have any shares, now would be a great time to start adding on. And then Robinhood. This was a little bit, I guess, kind of a love-hate because I had Robinhood at $37, $35 a share. Then April hit and I got out of it, and then that thing took off. But we did get in. We got in for, I think, around $60. So we're still doing excellent. Maybe not $60, maybe around $70 or so, because I don't think we're up 100%. But this company is doing extremely well. Their prediction markets that they rolled out has been a hit for them, and with crypto, with the options trading, and this investing, what's just in general, this is just an app for everything. But again, one of those companies that reported and didn't have a great. I'm not crazy, right? They did report. Yes, they reported, and then they did not have a very good. I'm trying to see. Yes, November 5th. They did not have a good run after they reported. Unfortunately, the stock is down 11% the past 5 days and down 10% for the past month. So, reported on the 5th, I believe. And then it kind of fell since then. All right, so this is going to bring us to the company I want to talk to you about the most, DraftKings. So I've beaten my chest and I said this prediction market fear that it is taking market share from DraftKings is completely overblown. And I started buying once it started to dip. So I've been buying probably since it hit about $35 a share. And unfortunately, it's been like catching a falling knife. But today was great because they reported earnings last night and the earnings came back and it was like, yeah, this is pretty much the same thing as usual. We just didn't have what you need to understand was sports books. They can't they can adjust the odds, right? But they can't predict the future. They're going to adjust the odds that are so they're going to be advantageous for them the best way as they possibly can. But if you have a run of favorites, which are heavily backed games, and the favorites win, that's just the nature of the business. Coming from someone who works in the casino industry, like listening to the table games departments when it had these high rollers that came over from overseas, and sometimes the high rollers win and they whip their butt. They don't let them get them change their whatever their game plan is, whatever their strategy is. Sometimes luck, in this case, gamblers come in, they're high rollers, they bet big and they win big sometimes. So it's a sign of the same. It's similar to the NFL games, the NBA games, whatever major sporting event that's going on. If the favorites hold and those are heavily bet favorites, that's going to be detrimental to their bottom line. And quarter over quarter, you can have those high fluctuations. Right now, non-football season, you're probably not going to get those huge fluctuations. But when NBA season's going on and NFL season's going on, and you get a lot of favorites hitting or a lot of heavily betted gains and the favorites are winning, that is going to be detrimental to the bottom line. This is a long-term approach. Over the long term, DraftKings is going to win. They make most of the money in parlays. Most people, that's how they bet sports. They don't want to just do a single bet because most people aren't betting hundreds of dollars in order to make a substantial profit. They're betting, $1, $2, $5, and they're stacking a bunch of parlays up to hopefully hit a big payout. 9 times out of 10, they're going to lose those bets, and that's how the DraftKings makes their money. So I understand the business. A lot of people, I can hear them asking the questions in the earnings calls. They don't understand the business. They just don't get it. They're expecting this business to operate like an Apple would or, any other publicly traded company where things are kind of consistent. If management's on their ball, unless there's some type of surprises, there's these one-off things that happen, you can kind of gauge this. In DraftKings, you can't really gauge it. Now, if you're a sports fan and you're watching and you know which games are bet heavily and you're watching it and you're, mindful of, oh, they favorite one big today, favorite one big next week. And then you get a string of a lot of underdogs winning in big games, and you can say, oh, DraftKings probably going to have a big quarter. Or for the Super Bowl, those major events that are happening. They probably have a lot of parlay bets that are coming in, so that's probably going to be advantageous to them, regardless of whatever the outcome is going to be, unless it's just a huge favorite. And then, Kansas City Chiefs are playing the Carolina Panthers. All of the money is going to be on the Kansas City Chiefs. If Chiefs wins, more than likely it's going to be a bad quarter or a bad day for the sports books. So I know I rambled on there a lot, just some things off the top of my head, but I wanted to give you some facts, some quotes, some information that came from the earnings call and that came from the CEO, Jason Robbins himself. So prediction markets will be used as, quote, a powerful lever to pressure states to legalize online sports betting states. So essentially what that means is California and Texas, they don't have legalized online betting. And so DraftKings they bought a company called Railbird, allow them to be able to launch these prediction markets in here. Now, first they're going to do just the political stuff, the entertainment, what color is the sky going to be tomorrow? You can bet on that type of stuff. Or Grammys, who's going to win a Grammy? You can bet on that. And then DraftKings is alluding to eventually they will launch sports events contracts in the states that are not currently legalized, like your Texas and California, to almost kind of say, well, listen, you see all of your residents are on our platform, but you're not getting any of this revenue because it's not taxed. It's federal. This is federally done, not state by state taxed. So when you're doing the prediction markets, and now that's the big thing about the prediction markets, they're not operated, and you don't have to have a license per state. It's just federally in all states they're allowed to do these prediction markets, at least for now. So that's the major difference. The online sports books like DraftKings and FanDuel in those legalized states, they have licenses and they get taxed. Whereas this new venture that they're going to launch, DraftKings Predictions, they don't have to have licenses for every state. It's federally operated and regulated, and they can just launch there and conduct business. And what the CEO is basically saying is they're going to launch in those states that aren't licensed and legalized to kind of put pressure and say, listen, we have all these folks on here. You could have all this revenue from the legal side if you just allowed us to open up shop in those states. So we'll see if that actually happens. CEO Robbins stated prediction markets are not a threat to market share, but could be used as a tool to address non-legalized markets like California and Texas, like we just said. They'll launch DraftKings Predictions. We talked about that. A quote here, as states see this continue to grow, the prediction markets, it's going to put increased pressure on policymakers to strongly consider whether they should follow the path of the other half or so of the country and just pass sports betting legalization, end quote. And then we talked about that as well. Another quote, I also think it's going to make policymakers think twice about tax increases, CEO Robbins said, noting that gambling operators can pivot to prediction markets if the taxes get too high. And that is happening, I believe, in Illinois and Ohio, a lot of these states, in New York, they're raising the taxes. Well, that would be interesting if DraftKings and the companies are saying, look, if you guys don't, stop this raising of the taxes or, meet with us in the middle, then we might have to just shut this down and we'll do the prediction markets, which I think is a little bit of a bluff because the margins of the DraftKings or a FanDuel get from the parlays or those other bets are significantly higher margin than what they can get from these prediction markets. And because it's new, it's going to probably take some time to figure this out, figure out the numbers and figure out how to operate this business efficiently and as profitable as possible. So I don't necessarily think that that's true, but we'll see. Time will tell. And then, quote, this is one of many reasons I think it's a huge positive for us. CEO said. It's a powerful lever in terms of what policymakers are going to be thinking. Legislators are aware of it. So it'll be interesting. I've been pounding my chest. Like I said, I was early. I think my average cost basis on for 100 shares in Robinhood is around $35. And then I think it might be a little bit less. In one of my other portfolio, I have another 100 shares. So I'm in for the long haul. We do have some options plays in those. We have options in NVIDIA, DraftKings, Uber, Meta, Amazon, the Qs, QQQ, Palo Alto, and I'll have to get rid of this one because we got out of that gold trade. So if you guys are interested in trading options, you can join our Patreon for free. We'll post these videos and other information in that Patreon for free. And then if you really want to get busy, if you want to trade with us, I post our trades in real time, exactly when we jump in. And then when we sell the contracts, we'll let you guys know. And we'll share how our portfolio is moving on a week-to-week basis. You can also have access to the long-term investing playbook, and that basically is going to show you our strategies, the things that we use to, the tools that we use to open up individual companies and determine their valuation and determine if they are, overpriced or it's at a discount or it's priced to perfection. So if that information is important to you, if you want to join an awesome community that is making money right now, over year to date, 70% of our trades are positive, and over 70%. Every once in a while we do have losing trades, but those are few and far between, and they are typically not big losses. We had some big losses early in this year, specifically on one company, and then NVIDIA kind of hurt us when the DeepSeek situation that came out of nowhere, and we got caught fumbling the bag there. But other than that, we've learned from those situations, and we've been executing at a high level and consistently pulling money out of the market, not just in unrealized gains, but realized gains. And then we show those gains on a daily, and a weekly, and a monthly, and a yearly basis. So if you like this video, make sure you follow us, make sure you like it, make sure you share, make sure you jump in the Patreon, either the free version or the paid version with all those tools and information, the strategies. It's only $10 per month. Enjoy your weekend. Be safe out there.